Hello, all. Welcome to the 6th of January Monday trading session. So, one change has happened in this new year, and Sensex's expiry date has moved from Friday to Tuesday starting this week. So, today is Monday, the 6th of January, and tomorrow, 7th of January, the Tuesday, is going to be the expiry of Sensex starting this week onwards. And now, let's look at what happened in today's trading session, how Sensex did, and what positions we took. So let's look at the 5-minute chart, and we see that the index started slightly on the positive note around 79,500, and it just kept coming down, and towards the end of the day it closed towards the lowest point of the day, and the lowest it did was around 77,840, but it did close around the 78,000 mark. So it's gone on a negative side today. It's closed just below 78,000 mark with a total change of minus 1.58% today. So it has been another negative day. Yesterday was a negative day as well. Today is another negative day. And let's see what new positions we entered for this week. So today Tuesday. So today Monday, one day before the expiry. We have, because of the change in the expiry date, we are left with only 2 days. So that is today and minus 1 day, and today is the last day till expiry. So what I did was around today afternoon time, 1:50 time, entered short strangle yet again. I sold a single lot of call 80,500 CE and a single put option on 76,000 P strike price. Note that it is a single lot, 20 units. This is another change that has happened starting this week. So the contract size of Sensex as index has increased. The option contract size has increased from 10 units to 20 units per lot, and which means the margin requirement has also doubled in accordance. And the expiry date moved from Friday to Tuesday. So those are the few changes that happened, and there is a lot of discussion in the trading world, particularly the retail traders. It looks like it is going to affect the participation in a negative way. There'll be lesser participation with these changes happening, with the increased margin size and the increasing contract size as well. So in our case, I sold the call and the put for a combined premium of 29.7. And let's look what is the current position that we have. We're just there as of end of the day, and 1 day left to the expiry. We're just hanging there. And now there is a logic behind why we chose these two strike prices, 80,500 C and 76,000 P. So it is not a random decision. It is certainly not a feel-good decision. I just looked up these numbers, and these numbers looked good. They looked far away from the current strike price. Maybe you can say it at a high level. If you see, when I entered the trade around 1:50 p.m. time. So here we are, 1:50 p.m. time, and you see we were 77,980, more or less where the expiry actually happened, right? More or less almost there. And the strike price I chose was 80,500 C, which happens to be 2,500 points on the upper side, and 76,000 P, which is approximately 1,950 or almost 2,000 points on the lower side. Now this corresponds to close to 3% away. This corresponds to close to 3% distance on the upper side. The call 80,500 C is almost 3% away from the current spot price, and similarly on the lower side, the strike 76,000 is approximately 2.5% below the current spot price. So high level first approximation, okay, you can say you are 3% or 2.5% away from the current spot price, and you're left with only 1 day till expiry. And all you're seeing is, even at the maximum, you're seeing bad days where there has been a negative 1.5%, negative 1.6%, negative 1.8, 1.9% move on the negative side on a daily basis. So you're still taking in some buffer. So all the cases has been less than 2% or less than 2%, right? So you're still taking a buffer of another 0.5% and saying, let's say, a really good chance that the index will not go down by another 2.5% on the lower side, right? But we'll still have the entire day tomorrow. We can continue keeping a watch on it. And there's a move that's happening very suddenly against us within the first half or within the first few hours. Then we can take a decision if we want to exit this one lot. But that's the first level assessment why we chose the strike price. But there is a deeper reason and that is now select that this price is based on statistics. Yes, you heard it right. We will have a dedicated video where we'll understand this concept at a deeper layer, at a very deeper level. We'll understand this concept. But right now, what I want to say is, so what do you mean by statistics? I'll zoom out to a daily chart, right? This is how I see Sensex has done over the past few days or past few weeks as well, right? If you see, what you will see is it's gone up, it has gone down on a random basis. It has done it, right? So of course you will see one pattern. You will see there is some kind of curve or a wave. Once it comes down, it starts going up, and then again after reaching a maximum, it starts coming down, right? And in between there will be some gap ups and gap downs while you see it, and there are some bunch of days which are close to together, and there are also some days where it has been in a trend for few days. From low to high it has gone, and there have been few days where it has been coming down from high to low. It has been making, but there have been other days in between where things have been on a random basis, where it's gone up one day, gone down another day, and gone down another day again, it's gone up another day. So if you take a net how the index moves, or for that matter any stock, in mathematical terms you can call it a random walk. You cannot really predict exactly where it will go, but there is a equal chance that it can go either up or it can go down. That's what the market hypothesis it says. So based on this, if we consider statistics, then if you know the average movement of the index or average daily move of the index for the past certain time, and if you know the standard deviation, the variance in the average itself, and by knowing the number of days remaining till expiry, how many days still remaining till expiry, you can kind of predict what is the worst case or maximum move you can expect in that direction. Theoretically, based on the past history that you have, that a certain average changes happen on a daily basis, and that average has been offset by a certain variance or a standard deviation, right? There's a way you can know the what is the most expected range in which this Sensex would expire, right? So say for example today, if it is uh, around 78,000, say today's close has been around 78,000, then knowing how the Sensex has moved, index has moved over the past few days, few weeks, it's easy if you apply statistical methods like average and standard deviation. It's easy to know what is the most likely range in which Sensex will close on the day of expiry, which is like just one day away. So in the next one day, what likely change we can expect. So for that, we will have a dedicated video where we will see how I calculated those values, the range in which most likely the expiry will happen in Sensex. But I can give you a very brief high-level overview I can give you, but still. So what I've done is I've written code in Python programming language, which does these calculations in an automated way. What it does is it fetches the movement of Sensex, historical closing prices of Sensex for the past 1 year, approximately 1 year time frame, and from that it will generate the average daily move and standard deviation, and based on that it will also know how many days are remaining till expiry. Today is Monday, so tomorrow one day remains till expiry, and within this one day it will apply the statistical methods, average and standard deviation, and from that the intelligence will be able to tell me as to what is the likely range in which Sensex will expire. So exactly this is when I execute this Python code, as you can see here. So it clearly says the upcoming Sensex Tuesday expiry for the weekly contract is on the 7th of January, which is tomorrow, which is correct. And then weekly expiry range, expected upper and lower bounds, right? Expected maximum minimum range in which it will expire. There will be 4 different values you will see, 2 maximum values and 2 minimum values, right? So the maximum values is like what is the maximum Sensex can actually make on a closing basis tomorrow on the day of expiry, and what is the minimum on the lower side Sensex can go, and what is the upper side maximum that Sensex can go. That's what these 4 values convey. And you'll see 95% confidence interval and 68% confidence interval is based on one standard deviation, two standard deviation calculation, which the details of which we will see in a separate video. But for now, you need to concern yourself with the most extreme values, which is the 95% confidence intervals which have the least value 75,786 and the most value 79,975. So basically what it's saying is Sensex most likely will expire around 80,000 and only 5% chance that it can expire more than 80,000. So 95% chance that it will expire within 80,000. And similarly 95% chance that Sensex will expire at a level of 75,000, 75,800 or above, and only 5% chance that the Sensex will expire below 75,800, 78,000. So we'll look into the details of this later, but I just wanted to tell you the decision behind the strike process we chose for the short triangle is not only because there are some 2.5 and 3% away from the current spot price when we enter the trade, but also because of this one assessment that we did, right? And you see the values that are above, you see are basically the daily change in Sensex on a day-to-day basis, with the latest values appearing at the top and the oldest values appearing at the last of this list. So there have been 244 days on which the previous 244 days where this daily change has been calculated by this Python code. And if you see, this highlighted the value is negative 1.58% minus 1.5%, which has been yesterday's change, a very negative move. And the day before that also was almost 1% Sensex closing negative. So the latest and the most recent values are at the top. So based on this, statistical methods have been applied by the script, and most likely expected data, a range of expiry were calculated 80,000 to 75,800. Within that range it will expire. That is the reason why we made the choice of the strike prices for the short triangle. And if you see, the exact value we took was 80,500 C, which is like 500 points above what the prediction according to the statistical method was. So we're just giving ourselves about 0.5% or 0.6% buffer beyond the worst case estimate, with 1 day left to the expiry. And similarly on the put side, we see that the strike price we selected is 76,000. Now you may see that the put we selected is actually slightly within the range as per the expiry analysis that we did. The range of expiry with the lower side for that was 75,800, and you will see the strike price we selected for the put, writing the put, was 76,000. The difference you'll see is because the assessment we did was on a closing basis, end of the day basis, right? But when we enter the trade, which was almost a hour and a half or almost 2 hours before the close of the day, the spot price was different and there was a different time left till expiry. So if you had run the assessment at that point of time, in other words, if you run the Python code, executed the Python code at that point of time, it would have given a different range, and the 76,000 we selected would have been just outside of that range. So it doesn't matter for us, it's not that different. It's just 200 points, which is like 0.25%, and from the current trading price we're still about 2.5% away. So the confidence is very high that both these strike prices will expire out of the money. But let's still watch out tomorrow, because as you would know, 2025, this new year, we entered with another unfortunate news of yet another viral infection spreading very fastly in East Asia. Again, China, Hong Kong and Japan, those regions. And there is a concern in the investment world. So let's see how the index responds to this today. Though Nasdaq has been making up move today as well. Nasdaq has made a positive move. It's been making a positive move since yesterday also. Nasdaq closed on a positive note. So if you consider all this, macros and the micros, we're leaving ourselves a good buffer, and still there's a good chance that we'll be able to keep all of the premiums to ourselves, and both the strike prices and the short triangle will expire out of the money. Let's see what happens in tomorrow's trading session. Thank you.